Hi, I'm John Cunnison. I'm the Chief Investment Officer at Baker Boyer. So since my last video last week, a lot has changed with the coronavirus, with people's uh, perceptions about what the impacts will be on the economy, and there's been considerable market volatility. I think during times like this, one of the most important things to remember is that this is a marathon, not a sprint. The changes that we've seen in the last week, we'll see more of that in the months and weeks to come. So I think what's really important today is to look to history for a guide about how we achieve the best outcomes for all of us as investors. It's key to remember not to panic. If we look at from 5 years from now, if we look back at this time, what will we hoped that we did? How will we hope that we acted? We know what the things are, and we need only look back to 2008 and 9 to get a lesson on what were the things that people did that gave them those really wonderful long-term investment outcomes. And the first thing is they didn't panic, that they controlled what they could control at the time. And often that meant simply rebalancing their portfolios. So as stock prices go down, bond prices go up, they simply rebalance from bonds to stocks. It's an incredibly powerful and healthy thing to do for a portfolio. And it's also important to remember that bonds are doing their jobs in this period of adversity. A couple of the bond funds that Baker Boyer uses, they're up over 10% during this time period. So it's really stabilizing the portfolios that we build. I think it's also important to remember that a lot of the people who led Baker Boyer clients through 2008 and 9, they're still here leading our response to this challenge. Now, there's strong data to support this approach to portfolio rebalancing during a period of market volatility. If we look at this chart, we can see what subsequent returns have been in the market after a downturn of 10%, 15%, and 20%. And we can see those returns over a year, 3 years, and 5 years. And what you'll see very clearly is that regardless of the level of downturn, those subsequent returns are strong. And if we look at where we are today with a return that is actually down over 20% on the right side of the graph, or the right side of this chart, down over 20%, those returns are quite strong. So over a subsequent 1-year period, it can be nearly 15% return on average. And if we look at 3 and 5 year, also quite strong, over 11%. So these are the types of returns that we should expect to achieve if we stay in our seat, if we stay disciplined, and we remember that we're long-term investors. So now is certainly a time for long-term investors to see quite strong stock returns in the years to come. There's also some concern about the government response to the virus. I think one of the things that's really important to understand is that the primary response to a pandemic comes at the state and local levels. And where we're seeing most of the virus activity, in Washington State, New York, California, some of those hardest hit states, we're seeing a very robust response from the state government and from those local cities and counties. So remember, this is a marathon, not a sprint. If we imagine in 5 years what we hoped we would have done in this moment, it would have been not to panic. It would have been to rebalance our portfolios into those lower priced assets. In short, it will have been to make those decisions that will have the best long-term outcome. I can't express enough how much we appreciate the trust that you have in Baker Boyer and in your team. If you have any questions, please reach out to any member of your team. We're here to help. So in closing, I'll just say, please take care of yourselves, wash your hands, and we'll be in touch very soon.